Welcome to the Chicago Money Show. I'm Bridget Sullivan Mermel, and I've got a fee-only financial planning firm in Chicago. One of the smartest books I've ever read about money is a book written for dummies. The author, Ann Logue, has written multiple books for dummies, including Hedge Funds for Dummies, Emerging Markets for Dummies, Day Trading for Canadian Dummies. We're going to be talking with her today about investing and if there's going to be a recession. What are the opportunities and what to avoid? Ann Logue, welcome.
Thank you. Glad to be here.
What information is most pertinent to our viewers right now about investing right now?
I think investing right now, the biggest change that we've seen in recent years is that interest rates are material. That's one of the things that's creating some volatility in valuations, but it also means that investors who've been looking only at common stock, they now should be taking a hard look at adding more fixed income into their portfolios. That bank CD rates are material. It makes sense to look at treasury bonds, which you can buy direct from the federal government at treasurydirect.gov. And it makes sense to look at money market funds and bond funds again.
Okay, great. So let's dig into this a little bit. Okay, so first let's talk about savings accounts. So this is, couldn't get more basic than a savings account, but things have changed for savings account. So what do you recommend now?
I think one of the first things is if you haven't shopped rates, it is time to shop rates because a lot of banks are crossing their fingers and hoping that you won't.
Okay.
There's a lot of savings accounts that are paying interest rates below 1% when the market rate of interest is approaching 3% for 4% for short-term money. So just start shopping rates, start moving money around. If you have money in a bank CD, a lot of people don't want to move it because they're worried about the substantial penalty for early withdrawal. But the substantial penalty is not as substantial as most people think. It's usually in the form of anywhere from 6 months to a year's worth of interest. If your CD is paying 1% interest and you can move it to a CD paying 4% interest, you give up 1%, you gain 3%.
Okay.
I mean, it's a no-brainer.
Okay, great. So I want to dig in a little bit on this, a little bit more detailed. So one of the things that I've found out is that a lot of people, multiplication, like 1%, 3%, it doesn't really mean that as much to them as I would think. So if I have $10,000 in my savings account and I'm earning 1%, well, first of all, a lot of savings accounts earn less than that, zero almost.
Yeah.
So the difference between one that earns 0.01% and 1% is
100 times.
Okay. So if I have $10,000 in one that earns 0.01, then I probably earn $1 a year.
Yeah.
And if I have $10,000 in one that earns 1%, I earn $100 a year.
Yeah.
Okay. And then if I go to 3%, I earn $300 a year. So I did a little bit of looking on the internet, that's the process that would take, and maybe fill out a form or two, and all of a sudden I'm making maybe 300 times more.
Yeah.
Okay.
And if you think about it like in terms of your hourly rate for that work, maybe you spend a half an hour on the paperwork, that works out to, what, $600 an hour? Right. Yeah. You're not going to get that much money at your job.
Right. Exactly. Okay. So where do we go to look for? You talked about shopping interest rates. Yeah. Okay. So let's talk about shopping. I like shopping.
Yeah. Shopping. I mean, really.
Okay. So let's talk about what you do.
You can start with your bank's website if you already have an account, because it'll take even less time if it's a bank you already have a relationship with, and look what they're paying. Okay. I would
say make sure you're getting that.
Yes.
Because I have experienced a situation where a bank it was an internet bank, and the internet bank attracts you with interest rates, and then they slowly but surely, they change the title of the type of an account or whatever, they just lower the rates. And so I had to look at it and said, wait, you're not paying what your website says you're paying.
Yeah.
But luckily it was when I called them, I wasn't the first person ever to say that. And they're like, oh, we'll just blah, blah, it just took a little bit of time. And it wasn't even a half an hour phone call. It was easy.
No.
And they changed my rates. And it heads up to me, make sure I check that every 6 months or a year, that I'm actually getting the interest rate that I should be getting.
Exactly.
Okay.
Again, if it's a bank you already have a relationship with, it's easy. And banks need customers. JP Morgan Chase maybe isn't quite as accommodating as others because the Federal Reserve Bank gives them new customers because of the bank failures, but they're an exception.
Right.
Other banks, they need to stay competitive, and they know people are starting to shop around. I would also go to treasurydirect.gov and see what kind of rates you can get from a treasury note, which is generally under 20 years.
Right, and we're going to look at that. We're going to talk about that in a second. Okay, so the next one let's talk about is CDs. So you mentioned CDs.
Yes.
Okay, so this is usually with a CD, it is a bank is, you set it up with a bank and they guarantee this rate for a set amount of time, generally say a year.
Yes.
Or they make it kind of hard because people might remember, I got this 12 months ago. They make it 13 months.
Yeah.
Okay. So, and again, it's always subject to they might change the rates when it renews. But I've had less problems with that than I have with the internet banks. Okay.
Yeah.
So let's talk about shopping CDs.
Okay. I've seen some local banks that put their CD rates on signs out front because, again, this is a competitive thing. When you're driving around, when you drive past a local bank, you might see their rates.
Yeah, on the Edens.
Yeah,
There you go. Yeah.
You know, you're sitting in traffic because the Kennedy's crawling, and there's people advertising to you.
And they're usually not; those are usually good rates. Actually, if they're bothering to do that costs them money to do that.
Yeah,
so they're usually good
want
rates.
customers.
Yeah.
You can also do an internet search. There are several different sites that track CD rates, mostly for internet banks all over the country. And there's no reason you can't open an account at any bank anywhere in the country. It's all federally insured as long as it's in the United States.
As long as it's FDIC insured, then and it can be sometimes like BMW Bank or like something like BMW has a bank. Who knows? But
the auto companies have banking divisions because they're doing loans and they need money from depositors so that they can fund the auto loans.
Right.
So sometimes they're not going to open branches. But they are going to advertise online, and if you search around, you can find them.
So one thing we've been doing is having clients buy or purchasing CDs in custodian accounts. So people have investment accounts at Schwab, Fidelity, or one of the other brokerage houses, and you can buy CDs directly through them, and you can shop a wide range of CDs and expiration dates and different terms right within their website.
Any of the large fund companies or brokerage firms can do that for you. And there's generally no fee for buying a CD. There may be a fee for selling a CD. They're less liquid than a bank CD. A bank CD, you have the interest penalty if you take your money out early, but you can get your principal no problem. With a brokered CD, you may have to take a small discount if they can't find another buyer. It rarely happens, but it is a risk.
Well, and it's not generally because it's FDIC insured. You're not talking about. It's more like you'd lose some part, but it's not like you lose the whole thing.
You're talking about like $5, $10 in most cases. Yeah. Okay. And they are FDIC insured even if you're buying it from a fund company.
Okay. And so you were mentioning before a play where you look at your CD rates and say, okay, are these current CD rates? Does it make it sense for me to sell this CD? And generally there's an interest penalty. It's not like getting a parking ticket.
No.
Like it's much not like that. It's more like just not getting a discount on a shopping thing. You know, like, so tell me more about that.
We moved some CDs for my mother-in-law, and the interest penalty on one was 75 cents.
Okay, so you just don't get the total amount of interest.
You don't get the total amount of interest, but The bank language for substantial penalty is not necessarily the customer's language for substantial penalty.
Okay, so now let's talk about U.S. Treasury Direct and the different things that are available there. So this is buying different investments through the U.S. government, so they are regarded as safe.
Yes, yes. You're buying it directly from the federal government. If the federal government stops paying, we all have bigger problems. We have a federal deficit. The government needs to raise money, and they need to raise it at competitive rates. And the way it works is they have periodic auctions. The only firms that can do competitive bids would be the very largest investment banks. But everybody else gets the rate that they agree on in the auction. And you place your order. You get your bond. Treasury notes are generally between 1 and 20 years, so match up similar terms to bank CDs. And the money is paid directly to your account. And the only catch is that if you need to sell it before it comes due, you do need to go through a brokerage firm to do that.
Okay. And we at our firm also buy those instruments, again, through the custodian. And it does make it easier to sell. But usually the purpose of that is to keep it until it expires. It matures anyway, so you're not sitting there looking to sell it.
Especially right now when interest rates are higher than they've been in a long, long time.
Great, so we're going to take a quick break right here, and we'll be back in a minute with more with Ann Logue. We'll be talking about if there's going to be a recession and other elements about investing.
Do you want to know what makes Chicago great at 8? Team Chicago Challenge. For more than 37 years, Team Chicago Challenge gives you very cool information about all things motorcycles that you've been very hard-pressed to find anywhere else. So tune in to CAN TV Channel 19 this week and every week at 9:00 p.m. for Team Chicago Challenge for more amazing, unique, and homegrown Chicago programs.
Hi, this is the Chicago Money Show. We're back with Ann Logue. And I want to talk about if there's going to be a recession, but I want to set this up with a few different questions first, okay? So to give people some backgrounds. So first of all, let's talk about hedge funds, and what are those?
Okay, so a hedge fund is a private investment partnership that is looking to maximize risk-adjusted return, which is not necessarily the same as maximum return. There are some that pay fairly low rates of return but do it steadily, that offer bond-like returns. Some are willing to take enormous amounts of risk in the pursuit of very high returns. For the most part, these have been closed off to individual investors. There are ways to get some hedge fund strategies now through ETFs. Just be careful when you're shopping around, because some funds, say some ETFs are set up for what's called an inverse return, which means the opposite of what the market return is. So if the market's down, it will be up, but if the market's up, it will be down.
Okay. Okay, so hedge funds are typically for sophisticated investors, and maybe companies or not companies?
Not so much companies, but often large institutions, pension funds, endowment funds are very big hedge fund investors.
Okay, so they're the people, the 1%. Let's put it that way.
Yeah, 1% of individuals. And again, a lot of people have hedge funds. If you have a defined benefit pension, it's probably investing in hedge funds, or if you're getting a college scholarship, it's probably funded in part by hedge funds at the university's endowment. But you yourself, for most people, it's not something they're going to want to invest in.
Okay, great. And it seems like every detective show I watched lately, the villain is a hedge fund. Or not a hedge fund, I'm sorry, private equity.
Private equity firm.
Private equity. So let's talk about what private equity does.
Private equity, those are investment partnerships that buy businesses outright, often with a high level of debt. And then in many cases, they're looking to improve the business. If there's been poor performance, or they might almost create a new company by merging a few different portfolio companies together. So they can create some volatility for the employees of these companies. And again, their sole concern is profitability. Mm-hmm. On the other hand, that has been one of the primary ways that companies have been getting funding in the current market. You're not seeing companies come to, do initial public offerings anymore like you once did. Not seeing as many companies come to the bond market to get funding. So a lot of people get exposure to that.
Okay. Yeah. Private equity, whether they like it or not.
Whether you like it or not, right.
Your employer might be part of that.
Right.
Okay.
Right.
So, but let's tease this out, because one of the things you mentioned is that they're often funded with loans. Like the private equity itself might be funded by borrowing money.
Yes.
Okay. So how does that work in with bank failures? And then we'll talk, okay, well, why are people thinking that might all lead to a recession, even though we have high employment numbers and consumer confidence is good? Okay.
That is a really big concern, because if a fund has taken on a lot of debt, they may have trouble meeting payments. These kinds of deals are often funded with floating interest rates, which means that as the rates go up in the market, the rates that they have to pay go up. And so for some funds, this is going to be creating a lot of problems, which then filters into employees at their portfolio companies may see a lot of employment volatility, shall we say.
You mean layoffs? Okay, employment volatility.
Yes.
Oh, yeah. That's a fancy way of saying
layoffs. Yeah.
Okay, so they can't make their loan payments, so they lay people off.
Yeah.
Okay.
Yeah, that is something that could be contributing. It's interesting, because when you talk about the possibility of recession, by most sets of numbers, it doesn't look likely at all. But it's interesting to see who's concerned about it, and it tends to be people at the very largest banks who have exposure to private equity loans and who have heavy exposure to real estate loans. And if people don't go back to work, companies are going to close their offices. Some companies may choose to close offices instead of laying off employees, but that starts to affect the ability of building owners to make their mortgage payments, which then affects the profitability at the very largest banks.
Okay. And so the bank failures have been, like, rising interest rates have led to some bank failures.
Yeah, and that's been very strange. Like, Silicon Valley Bank wasn't really in bad financial shape. It wasn't in great financial shape, but it wasn't that bad. But what started was just an old-fashioned bank run. But old-fashioned bank runs can get going very quickly thanks to social media. I mean, in the movie, what's the Christmas movie?
The one with Jimmy Stewart.
Jimmy Stewart.
A Wonderful Life.
It's a Wonderful Life.
Yeah.
It's a Wonderful Life. In It's a Wonderful Life, there's a classic bank run, but it spreads relatively slowly because
it's all people at the coffee shop.
People talking,
right.
And they have to go to the bank in person to get their money out. So they actually have to have a conversation with Jimmy Stewart about, and he's able to talk them out of the bank run, But if you are doing it online banking and you don't have to actually talk to a banker and you see things on Twitter and you get a little panicky, that's what happened with Silicon Valley Bank. With both Silicon Valley Bank and with First Republic, a big part of their issue is that they had huge deposits for businesses, but also for very high net worth individuals. So those deposits were never covered by federal insurance.
So there were large deposits.
Yes.
And FDIC insurance
goes up to $250,000
for each account easily, and then it goes. if you are if you're worried about that, I've got more than $250,000 in this bank, then there's additional coverages in certain circumstances, and there's a calculator that you can actually use to help you figure it out, because it depends on, like, do you have a joint account, do you have an individual account, do you have a tenant account, so it gets kind of complicated. But the fact is that it's $250,000, which eliminates almost everybody.
Right.
Almost every bank account.
Right.
So, however, Silicon Bank happened to have over 90% of accounts not covered. It's
Right.
like not covered by FDIC insurance.
That is an unusual situation because, again, the very largest banks have enormous accounts for businesses and high net worth individuals, but they also have an awful lot of checkings and savings from individuals, and that's a very stable base for them. They know every Friday how much money is going to come into the bank from paychecks. They know they can model over the next weeks about how fast the checking accounts will be drawn down until the next round of paychecks. They've been doing this for years, like centuries.
Okay, so swinging back to the recession idea. So we have this interest rate pressure that is kind of playing out a little differently, I think, than a lot of people thought. The government entity that tries to manage all these things is called the Fed, or the Federal Reserve Bank, and they are the ones that raise the interest rates or keep them steady. Now, do you have any idea what the Fed is saying right now? They seem to have been saying 5%. They'll get to 5% around this time, and the time has arrived, and they're trying to, here's what I've been very interested in, is that the Fed is trying to be very transparent.
Yes.
They don't want to surprise anybody.
They don't want to.
No surprises, yeah.
I think because the economy's, it's strong, but it's also, like, a lot of the support is fragile.
Yeah.
There's like some, and so I think the Federal Reserve is very nervous about spooking the market. So they're being very careful. And I think all of the market observers and analysts are a little unsure whether the Fed will keep this up or cut rates or raise rates again. And, they're looking at all these indicators. And again, employment is strong. If anything, jobs have been growing faster than expected. And strangely enough, that's because we've seen an increase in immigration, and there have been a lot of entry-level jobs that employers have not been able to fill. Things in food service, for example, or janitorial services, and those are entry-level jobs that people just entering the workforce tend to take. So now that we have an influx of entry-level employees, we're starting to see that, and that's good for the economy. That's how the American dream is supposed to work. You get your foot in the door and you go from there. So there's that. Consumer debt has come up, but it's still reasonable.
Manageable. Yeah. By historical standards, it doesn't seem bad.
No. By historical standards, relative to income levels, it's reasonable. Consumer confidence is okay. Everybody kind of knows that this won't last forever, but right now it's okay.
Right. Okay, interesting. So wrapping it up, I'd like to ask all my guests the same question, and that is, what brings meaning and happiness to your work and life?
To my work and my life. I really like work where I can meet interesting people and learn new things. And that is one of the really fun things that I like about being a writer, because I get to talk to people all day about what they do and just, learn interesting things, meet amazing people. It's been so much fun. Like I've met you.
Exactly. Through your writing.
And so that's something that I really find meaningful. And I really like if I can cut through a lot of the jargon and help people make better financial decisions. A lot of this is not as difficult as it's made out to be.
Right.
Again, like just when we were talking earlier, the confusion about what banks mean when they say substantial penalty for early withdrawal.
Right.
you know, they're thinking percentages, you're thinking dollars.
Right. It's not that bad.
It's often not that bad. No.
Great.
So I think that that's really important. And in terms of life in general, you know, I've got great friends, I've got a great family, we love to travel, and I'm really glad that I'm able to spend time with my family and my friends and that I'm able to travel.
Awesome. My name's Bridget Sullivan Mermel, and if people want to find out more about you, where do they look?
I have a newsletter on Substack called The Whatever Years.
Okay.
So you can go to thewhateveryears.substack.com.
Awesome. And my name again is Bridget Sullivan Mermel. To find out about my family financial planning firm, you can check out www.sullivanmermel.com. Check out this show's website at chicagomoneyshow.com and sign up for a newsletter so you can get a heads up before upcoming shows. You know, I just want to mention I also have a YouTube channel called Friends Talk Financial Planning. If you're interested in the topic of I bonds, which we covered briefly on the show, we go into that in a lot more depth on Friends Talk Financial Planning. If you've got the questions on this episode or for future episodes, please email us at ask@chicagomoneyshow.com. Thank you for watching.